Hey, everybody, welcome to another weekly market pulse. Too bad we have a poopy, stinky red market. But anyway, I hope you're doing well. Let's get into it. It's a red market, like I said. Let me show you some slides so you don't think I'm just making this up. Here we go. So here's what we have. We got 4 red lights, and we have a definite downtrend in the market. Now, these downtrends can reverse, and this one is getting long in the tooth. It's, the red market here has been about 8 days long, but we've got a couple of our indicators that have been, red for a lot longer than that. And I'm telling you, you got to use market timing in your strategies because 70% of a stock's direction comes from the direction of the market. About 30% of it comes from the direction of its industry and sector. You put those two together, you're starting to stack some decent probabilities. And if you got some kind of market timing system that's telling you, hey, you should be in the market, or you should be in cash, or you should lighten up your position, it really does help you a lot. And, Wall Street will tell you that you can't time the market. Wrong. Like this, I have a system that's right like 75, 80% of the time. You could see these little red dots that say R on them, and they're right. Okay. R stands for red, not right. But, the idea is that we try to get you out when the markets are going down. I don't know when it's going to stop. It could stop today. It could stop next week. It could stop next year. I don't know. But right now, if you're not listening to the fact the market is red, you're probably losing money, especially if you're in Apple or Nvidia or, some of these other stocks that are, they're getting punished. All right. So, and I wanted stocks have memory. And so you could see this line from a couple of months ago. It hit it twice, and it hit it again yesterday. So I find it really interesting that they go back and they revisit these prior lows, they test them, and maybe it takes that low out. Certainly today, as far as this chart goes, it took that out, and now it's back going the other way. Now, could it continue? I don't know. To me, it's early. You don't want to jump back in because it hit this little line. That's a silly reason, right? There's got to be several other probabilistic things that work. Let's take a look. Look at that NASDAQ chart over here on the right. This is not, if you're long, you don't want to be in this kind of chart. And, several weeks ago, I had a bunch of Tesla and I took most of it off the table. I went almost all to cash a few weeks ago because my markets, my indicators were telling me that things were turning red. And so when things turn red, I start to listen. And I'm so glad I did because I always say this, it's better to be out of the market wishing you were in than in the market wishing you were out. I'm out of the market primarily wishing I was in. I've got a couple of covered put positions. I've got a couple little things, but most of my account is in cash. All right. Look at this index. This is the NASDAQ. Boom, down, huge. Look at this index. This is the S&P 500. Boom, down, huge. Now, are they oversold? Maybe. Look at the Dow. Boom, down huge. And not just a little bit down, like straight down, right? New York Stock Exchange, boom, down huge. They're all below the 200-day moving average, most of them anyway. Yeah, they all are. And that's telling you that the market is selling off. There's more sellers and buyers lurking out there on the street. And every time somebody tries to run it up, the sellers hammer it down. That's the way these red markets work. And they could stay redder a lot longer than you think they can. Okay. Don't be trying to catch a falling knife just yet. Look at the volatility index. This is the panic index. This is spiked up from 1474 all the way up to almost 30, like it's doubled. So there's a lot of panic in the market. The transport average, right? 17,845 all the way down to 14,000. That's a significant drop. That means goods aren't moving around as much. And you knows that because the oil, the prices of an oil chart are down too. So oil is down, selling less oil. Even it's getting cheaper because we're going to be bringing a lot more out of the ground. And the transports are down. The transport Dow theory says if the transports are down, the Dow's probably going to be down. So there might be more pain ahead. This is not looking very strong even on this little bouncy day today, right? Gold shares are up. What does that tell you? That tells you that there's probably going to be some more money printing coming soon. If you've looked at the M2 chart, you'll know what I'm talking about. M2 is going crazy again. That means they're printing more money. What happens when you print more money? Assets go up in value. Houses, gold, Bitcoin. All kinds of assets are going up in value. So that's what's going to happen there. Excuse me, I get a little frog in my throat. All right, the housing index, on the other hand, because there's so much stuff on the market in housing is coming down, which means they're not going to be building as many houses, at least for a while. Semiconductors are down. If you're in semiconductor stocks or computer stocks, you're feeling this. The market indicators, you can see there's a lot more red, a lot more selling than stuff going up. That's a bummer. Apple. I don't know what's going on. This is a lousy candle, guys. This is telling you that Apple probably wants to go lower. It's not a huge volume candle yet, but I think it's going to be by the end of the day. And Apple is rolling over. This is a death cross that's happening on the 10-week and the 40-week. This is a red candle that's closing pretty close to the bottom on decent volume. I think it's going to try to head to that, that $200 or that 193 swing point. Here's what the swing points shake out. 260 down to 269. That's about 41 points. A bounce at 250. That brings it down to 210. That's stop number one. Stop number two is 200. Stop number three is 196. That's where I think it's going. It needs a lot of buyers in order to be able to save it right now. And there's a big seller or something going on out there. Look at all the volume here. So something's going on in Apple. MicroStrategy, same thing, but now we're getting a bounce off the 200-day moving average, off the 40-week moving average on this chart. Pretty healthy in this market for it to be bouncing off that average. Look at this little wedging pattern going down. And I think if it can get back up over that wedging pattern on some volume, heading up over to 300, I think we might have a little sustained uptrend going on. We certainly have 4 days in a row of MicroStrategy bouncing off that 200. And it's the third week in a row that it's bounced off the 200-day moving average. Pretty healthy. All right. Tesla, there's a gap look at this gap. This is the coolest thing about markets, right? You see this gap, and I put a line there, right at the bottom of that little candle there, about 212. Look what it did 3 days ago. Tesla came to that gap, filled it, bounced right off the low of that swing point, and it headed up the other side. Now, will it hold it? I don't know. Maybe, but there's a gap there. This, there's also, this is the weekly chart. I want you to see there's been a lot of selling here on volume. So, it may bounce, but there's a lot of sellers here. Now, it'll probably be bouncing back up to the 200-day moving average or something like that. I don't know. But I can tell you that this has been a falling knife from 488 all the way down to 220. And it's not been fun if you've been in Tesla. And this Tesla does these. Look at these big moves that Tesla makes, right? They have these big, crazy moves. Now, they end up recovering over time, but you got to sit through a lot of pain on Tesla. So just be careful. I know we all think Tesla's great, or some of us do, and some of us don't anymore, but whatever. You can see there's still a gap out there at the 139 level from a year ago almost. And so just be careful. It may want to go and tag that 139 gap, like it did the 212 gap. Nvidia is rolling over. There's a death cross here. You can see that there. It's an ABCD pattern on the way down. There's a gap up, but it's on weak volume, I think. I think Nvidia has just got some problems, and certainly when it comes to the chart. Now, if we can get this to start going back up the other way, which is going to take a lot of buyers and a lot of work, then we're talking about a 143, 144 breakout price. But we're a long way from even thinking about that. This has all got to be structured on the way up to get a double bottom. All right, one more. Amazon, actually 3 more. Look at these 3 charts. This is Amazon weekly, Alphabet weekly, and Microsoft weekly. Don't they all look kind of the same? That's because the whole computer index is down, and there's weakness out here. And so even these really strong stocks that we want to invest in because we feel like we missed them, don't touch them right now because they're falling. And there's probably some more pain to go on some of these stocks. All right, the market's red. Hopefully you're in cash, or at least you're short, and at least you're learning, if nothing else. But there's more important things than making money, and I hope you are enjoying some of those more important things, like the love of your family, smiling, laughing, all those other things. Don't worry, the market will be green one of these days again, and when it is, hopefully you'll be back in. If not, maybe you're short, or maybe you're sitting in cash right now and enjoying this. But meantime, thanks for being here and joining me on the Market Pulse. I'll see you next week. Have a great weekend. Take care.